My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. You can't hope for rate cuts from the Federal Reserve and also expect zero weakness in any part of the economy that impacts your portfolio. Let me tell you, Wall Street wants to have it both ways, but we'll never get those rate cuts until the Fed sees cash-strapped consumers rebelling against higher prices, forcing companies to roll them back to pre-COVID levels. And that is what is at stake right here. And it's playing havoc with the averages. Dow sinking 234 points. S&P falling 0.77%. And the NASDAQ losing 1.05% again. How can investors navigate these treacherous waters where we want just enough weakness in the economy to push the Fed to cut, but no damage whatsoever to the stocks of companies we own? Well, look no further than the stock of the Walt Disney Company. I follow Disney very closely. We own some for the Charitable Trust. I like it in part because of the price. Disney traded at 123 and change back in March. Board shareholders, especially the big index funds, voted against Nelson Peltz, canny investor who wanted to join the board and offer advice on cutting costs and reorganizing the business. Now it trades at 86. And it sure, even here, feels precarious, as no one seems to care at all about the value of this storied franchise. Today, the company reported what looked like, on the surface, a terrific quarter, and initially the stock jumped up $5 in pre-market trading. Then Disney quickly reversed and ultimately finished the day down $4. Not unlike the Dow Jones average, where things look real good in the morning, then dripped lower the rest of the day. Emblematic. Disney's actually the perfect microcosm for the moment. They've got a bunch of important divisions, like movies, where Disney's crushing it. Terrific schedule. I think like huge hits like Inside Out 2, Deadpool and Wolverine. Seems like the movie drought's over. ESPN held in with ad revenues up 17%. Good news, despite the cord cutting. But what got me excited about the company's results? The amazing profit, a quarter ahead of time from Disney Plus. I figured it would disappoint us again, and maybe even again. And we hear the usual refrain, only Netflix knows streaming. Disney will never get it together. Wrong. Move over Netflix, or at least slide over a little, because Disney Plus pulled it off, delivering a real profit. It did so a quarter earlier than planned. That, to me, was the real story of the day. But not in this kind of market. If Disney was so good, you're probably wondering, what the heck did the stock get beaten black and blue today for? And the answer is exactly why we need a rate cut. And we need a rate cut right now. The consumer no longer seems willing to pay up for these storied and treasured family-friendly theme parks. Long the most consistent part of the Disney mosaic. You can count on them. The parks failed to deliver this time, failed to deliver big. I don't know if they can deliver in this environment because they may be too expensive for the newly frugal and choosy consumer. Sure, the parks are exciting, but when you have to pay $734 to spend a night at the Grand Floridian, or $635 a night at the Polynesian, or even $526 a night for the night at the Contemporary, all on top of the $109 standard theme park ticket price, $109, well, consumers are going to have to make a choice. And maybe the choice is to not go to the Magic Kingdom. And that's why Disney's domestic parks operating income fell a pretty shocking 6%. But with management saying this demand moderation could impact the next few quarters. So what choice is the consumer making instead? Perhaps she's choosing to go on a non-Disney cruise, perhaps one owned by Royal Caribbean, which is mostly sold out, judging by what the company had to say about the state of their business. And their stocks are telling you that the state is pretty darn good. While Magic Kingdom room rates are expensive, Royal's Western Caribbean and Perfect Day Cruise will only set you back $114 a night. Bermuda, $132. You can sail 5 days for the price of one overnight room at the Floridian. The consumer still wants to go person. They definitely want to go. They want to travel. Post-COVID, you can only live once instinct, still with us. Top of the list of things that we're spending on. Right out of the pandemic, people were more than happy to pay Disney prices. But we've changed. We're now a lot more choosy after years of higher prices, inflated prices. We're done. We're done. You can have a terrific time on a cruise and take just as good pictures for your Instagram without Mickey or Pluto photobombing your Insta action. Despite all the negativity, I come back and say, well, wait a second. There are other things besides just theme parks. You can get this incredible franchise for just over 17 times earnings, much cheaper than the average stock. I haven't seen this cheap in a very long time. I told people along the investing club today at our morning meeting at 10:20 that I am itching to buy back the stock we sold much higher if the pelts fracas. I think the parks problem can be solved, unlike the streaming profitability problem, which I thought would just kind of be with us for a while. Because the rest of Disney's at last working so well, you know what they can do? They have the ability to cut prices at the parks if they want to, even as I know those places cost a fortune to run. And I'm confident that the Fed will cut rates, which could take the pressure off the consumer away from the parks. What happens then? Well, I think Disney's parks bounce back because it's not like they've lost their relevance. It's not like they've stopped being great places to go. They're just more expensive than the alternatives, like cruises. Fortunately, Disney has a cruise line of its own. It's expanding, but not fast enough. And the gross margins on new ships are getting in, well, they're not as attractive as the broken-in ships. Of course, I brought up Disney not just to harp on the fact that I think it's a bargain here. And yes, if it goes to 80, it'll be more of a bargain. I brought it up because it's emblematic of problems that many companies are having. One of my favorites, Airbnb, told us just last night that it's seeing a slowing in domestic bookings again, something that's new, something that's worrisome. It dovetails with what Marriott's seeing, another good operator. I thought Airbnb was such a bargain, it wouldn't get hurt. But right now, consumers are under such pressure that Airbnb seems pricier than we thought. Also, if you bought your home with a high mortgage rate in the last couple of years, you're going to charge more to rent it. And then maybe it doesn't get taken. Unfortunately, you can't roll back Airbnb prices in some central office, but I sense that some deflation's coming here, too. Now, we know the consumer's odd sometimes in making her choices. I mean, she's still spending a ton on Ubers and is willing to pay through the nose for restaurant food deliveries, accepting the toll that DoorDash charges on each sale. Why? You know what? Different things occurred during COVID. I think the consumer learned to love the convenience during COVID and now just doesn't want to give it up. When you hear economists talk about this process, you know what they call it? They call it normalization. The end of all sorts of exaggerations we saw because of COVID or perhaps the post-COVID supply chain hangover. The consumer got real liquid from doing nothing during the pandemic and was willing to accept the higher prices at theme parks, but that's no longer the case. We have what I call an empowered consumer. And that consumer is going to force rollbacks on price by voting with her feet. She isn't mad as hell and not going to take it anymore. She's just mad at some options and happy with others because they're cheaper and better. Bottom line, the Fed can rejoice and stretch the time before it cuts rates until it sees the Disneys of the world cut prices en masse. Or it can anticipate what's going to happen and move now. I think it does the latter, but the consumer's still not going to come back to Disney World until the Grand Floridian drops to the price of the Polynesian and the Polynesian dips to the price of the Contemporary. Until then, the stock will languish like so many companies that have tried to hold the line on high prices because that's now a losing proposition to which both Wall Street and the consumers rebelling. Let's go to Luke in Louisiana. Luke.
Booyah, Mr. Cramer.
Booyah, Luke. What's going on?
It's good to talk to you. I'm calling about IBM, Big Blue. I usually just bet on LSU to beat Arkansas. That's candy from a baby. But I've been looking at IBM. And the market cap has been holding here for 20, 25 years. Now I'm hearing about quantum computing. I'm hearing about that they're the forerunner in commercial security. Is quantum computing the real deal? Will IBM, Big Blue,
you don't need quantum
computing
to be the real deal. They are just executing like a fast Gillette razor. I got to tell you, I really like what's going on there. I think the stock's valuation is not stretched. You still get the dividend. They're doing a terrific job. I think. Bye. Mike in Oregon. Mike.
Hey, Jim. Beaver Mike here. Hey, I'm looking to increase my industrial exposure. I already own Honeywell and Stanley Black & Decker and considering starting a new position in either Eaton or Dover. Given the current market, which of the two would you recommend to start with, or is there something else?
Okay, no, and I think they're both great. Now, both of them are connected to the data centers, you know, but Dover has less data center as a percentage of its mosaic than Eaton does. I would say buy Dover right here. I'd pull the trigger, you know, because you're a club member. I can tell. That's the one you want right here is Dover. Let's go to Daniel in Alabama. Daniel.
Jim, booyah.
Booyah, Daniel.
Long time listener. Roll Tide, man. Hey,
okay.
Out my mom, my dad, and my Aunt Elaine. Hey, so my question is on Moderna, all right? So pre-pandemic buyer, I've seen the process. I've trimmed along the way. get a little knee-jerk with price action recently. What do you think about that one, outlook-wise?
Okay, I think that Moderna, I was hoping they could use AI to solve the puzzle here, but Moderna's not producing the personalized cancer vaccines that I thought they would. And that is a lot, like a lot of other people, we feel let down by the company. We feel let down that Stefan Bancel, has not been able to crack the code of cancer with personalized vaccines. And that's why that stock keeps going down. All right, listen, the Fed can rejoice and stretch the times before it cuts rates until it sees the Disneys of the world cut prices en masse. That's one way to look at it. Or it can anticipate that that's what it's going to happen and start cutting interest rates real soon. On Mad Money tonight, CVS Health chopped its 2024 forecast for a third time this year, with the stock heading lower on the news. I'm checking the company's vitals in my post-earnings exclusive. Then the stock of Celsius has been a dog lately, but what the heck? They just reported another record quarter. What's going on? I'm talking to the CEO. And Devon Energy is moving higher after earnings. I'm drilling down on what's next for what could end up being the premier independent oil company in this country. We'll sit down with the company's top brass. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.